Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is real estate investment expert Daniel Farber. Now, Daniel is the CEO of HLC Equity, a multi-generational real estate investment firm focused on acquiring and operating multifamily and commercial assets. Now, HLC was founded 75 years ago by Daniel's grandfather and started accumulating commercial assets back in the 1950s. Now, fast forward to today, and HLC's portfolio runs the gamut, including multifamily, grocer-anchored retail, triple net, single tenant, and multiple others. And so, without further ado, I'd like to welcome Daniel to the show. Daniel, how you doing, my friend?
Wonderful. Thank you. And thanks a lot for putting this on and for having me today.
Yeah,
Appreciate
excited
it.
to have you here. Yeah, absolutely excited to have you here. Excited to learn a little bit more about your company. Obviously multi-generational. So, there's it's just very excited about just the kind of the timeline, what that looked like for you growing up, getting into the business. But before we go down that path, I gave you just that very brief introduction, Dan. I know there's a little bit more to the story, and so how about
Sure.
start off for those folks that aren't familiar with you, that don't know anything about HLC. Tell us a little more about yourself, your background, and then exactly who HLC is and what it is you guys do.
Sure. 100%. Thanks a lot. So, interestingly, HLC Equity, we're a multi-generational real estate investment firm. And interestingly, I did not grow up, thinking that I would be in the real estate business, nor was it on my mind whatsoever. I mean, basically, the snapshot story, and whoever's interested, there's more on it online. But basically, my grandfather built up a portfolio alongside some other businesses he had, and eventually, when he passed on, it was family holdings. And I, on a personal level, went on my own track, which included military service and then also working as even a journalist, but then also as a strategic consultant, and eventually found myself also doing my master's degree in business and real estate investment. And right around that time that I finished, at that point in time, the family business was really family holdings, and primarily focused on neighborhood shopping centers and net lease assets. And I was asked to join the firm. And so kind of the arrangement for joining the firm was, okay, we're going to join the firm, but we're also going to build the bigger strategy of how we expand. So, kind of throughout the years, we worked on both expanding the retail portfolio and then also getting into other asset classes. So today, really, our focus is on multifamily, mainly in kind of like the growth markets, Denver, Dallas, and the like. Value add and core plus is really what we do. I'm the CEO of the company, and just having a lot of fun and making good investments. I have not done a lot of investments for the last year and a half, which I'm sure we'll get into. But that's the nature of the game,
All
cyclical.
right. Fantastic. So just to better understand, so has it pretty much been a full pivot from net retail investments over to multifamily, or are you guys still, do you look at opportunities in other asset classes?
Yeah, I would say we do. We look for opportunity in asset classes where we feel we have some sort of knowledge or edge, over competition. So we definitely, because we've been in the retail business for so long, we're able to size up, tenant and occupancy and so forth. But we're not actively pursuing, kind of like on our growth path, we're not actively pursuing more retail acquisitions. But if stuff does come along, then obviously, and it's interesting to us, we will look at it. Also, because of our net lease business, and we've also done some kind of like more medical office oriented assets, we are looking in that area. But really, our primary focus over the last several years has really been multifamily.
Just curious on kind of navigating away from having focus on retail neighborhood investments. It just is it not necessarily fully believing in what the future holds for that asset class, or were there other reasons to make that pivot?
Yeah, so wide ranging, but I would say there's two primary items. First of all, definitely when we made the pivot, it was kind of like Amazon was coming on the scene. It was gaining a lot of momentum. This is going back to kind of like 2012. And you could just see that, retail was shifting, and we didn't know what exactly that shift meant for for the everyday retail that users are that where the end user is the consumer. And so we kind of looked at that and we said, okay, that we need to be very cautious in terms of where we invest because of this shift. The other thing is just as a business model, retail real estate, thankfully, has been very good for us, but it's also a different animal in terms of investment and also risk tolerance. So it's funny, I have some people that I speak with, and they think that retail investment is more safe, which it just all depends on what you're looking at and how the retail asset is. But I mean, essentially, a lot of the assets that we used to buy them because it made sense when you could buy it at, call it an 8 cap, and finance it at a 5 to 6 cap, and then it was just primarily cash flow, like your book in the back. But the problem with that is even if you do that, if it's on a credit tenant and you have a 10-year lease, you're essentially losing value unless cap rates compress. You're losing value every single year because the lease, is short, and it's essentially like a bond play. So if we do stuff today, it's more going to be, maybe we find something where it's a short-term lease, but we feel very confident we could release it. Something where we have to get our hands dirty. And then there's just the essential, the basic fundamental of housing is, one of the most in-demand asset classes out there. And if you have a building and there's a big tenant and that tenant goes dark, and all of a sudden, you have thousands of square feet that are dark. Whereas, as it is with multifamily, I mean, obviously, a tenant decides to leave, which we also work a lot on our multifamily side. We work on retention, but if the tenant does decide to leave, obviously, your worst case scenario is you reduce the rent.
Sure. No, absolutely. And is your multifamily strategy a buy, add value, and then sell, or are you guys typically long-term holders?
It really depends. It depends also on the asset. And so, going in traditionally, again, we were kind of like just more of a family holding business. We set out and created a sponsorship platform. And so really it depends on some of, the investors that we have in our deals and how we feel about the asset. So as an example, we have some deals that they're relatively new vintage deals. And, we don't mind owning those for the next few decades. But there's other deals that we see where, maybe it's a 1980s deal, but we feel we could add some value to it. But it's not necessarily something we're going to want to own for the next 10 to 15 years. So then our business plan may be, kind of more short-term oriented. But always, if it is a short-term oriented deal, we are focused on being properly leveraged. So, like if we call it a 3 to 5 year deal, we might put on a 5 to 7 year fixed rate, kind of low leverage debt on it.
Understood.
Yeah.
So speaking to the some of the major changes that have happened in the capital markets, interest rates, going to historical highs in a very short duration, just what are some of the major pivotal changes that you guys have made within the organization to, I guess first and foremost, adapt to all those massive changes that happened fairly abruptly, but then on top of that, kind of planning for the future.
Yeah. So, obviously, while the acquisition market has been a little bit less attractive and we've been a little less active, we have constantly been underwriting deals in order to understand what's going on in the market, right? Because that's the best information that we can get is our underwriting team underwriting deals and even making offers and seeing where we are on our pricing versus where the market is. So we've been doing a ton of that for the last. I mean, we're always doing that. And we have some internal projects that we're working on just with our own portfolio where we feel that we could add value within our own portfolio, whether that be refinancing or, creating a new business plan for, specific renovations on some of our properties. So that's really kind of been our focus is, being active in the market in terms of, the other area that we've really been focused on is making sure that we're constantly in touch with kind of like our outbound acquisition prospects. So that would be owners, lenders, and brokers, so that we are the first call. Is what our goal is that we're the first call when a deal becomes available or something interesting comes up.
And what are you guys seeing? Being that you're actively looking at deals. I know you said you haven't had much acquisition activity over the past year and a half. You're actively
Yeah.
looking at deals. You're underwriting deals to get a general sense of where the market is at, and even making offers. Um, what are you seeing? I mean, just from your perspective, your company's perspective, on the deals you're looking at, is it just too much of a spread between seller expectations to that of what buyers are looking to pay, or what's happening out there?
Right now, I would say where we are is it's still kind of like there is some sort of price discovery, but we're very much seeing that there are starting to begin what we have been waiting for, which is sellers who need to sell. And I wouldn't call it distress scenarios, but it's becoming more and more interesting. So cap rates have definitely obviously come up. They're on good assets. There's still not positive leverage. At least those deals are few and far in between to the extent that they do exist. But we're seeing slowly starting to see kind of cap rates coming to an area and the basis of which we can get the properties to come to a space where we feel very comfortable. But by the way, our work in terms of our outbound communication with lenders, brokers, and owners is starting to pay off, because we are starting to get those phone calls of deals we can buy at the par value of the loan, because they need to sell due to the interest rate increases for folks who had very short-term debt. And so now the question is, even at the par value, do the deals make sense? And they don't always. But it's just kind of showing where the market is heading.
Are there any particular markets that you're placing more of an emphasis on at this point in time? I know you'd mentioned,
Yeah.
Dallas, Denver, and I think you mentioned a few others, but are there any more specifically that you're really, putting your keen focus on?
Yeah, so Dallas is definitely a market where we're very active in, and we have we're also we're a vertically integrated company, so we own and operate, and we operate in Dallas, and so that's a market that we also feel very comfortable in. And we've been active in Denver, but we more recently have actually sold our assets in Denver, and we're not actively in that market. There are other markets that we're interested in. So Columbus would be one of them. Our director of acquisitions is in Atlanta. Atlanta, has some challenging factors to the market, but there are also some very interesting factors over there as well. So those are kind of the key markets where we're focused. But we're also pretty opportunistic in terms of where, as long as the markets have the fundamentals we're looking for, which is affordability and positive population growth.
In Denver, just curious as to maybe the reasons for exiting out of that market. Is regulatory risk,
Yep.
or just was something
So
else?
yeah, so I grew up in Denver, and I love Denver. I think Denver is a great city. And the primary reasons that we're less keen on investing in Denver right now are the regulatory risk, as you mentioned, and the affordability. Right? It's just, I mean, like, rents there are through the roof, and buying on a per unit basis, multifamily there, it's starting to get a little bit better, due to the market kind of going down and the fluctuations, but it's still, those are the primary drivers, are really affordability and regulatory.
Got it. Got it. Is there a rent control on the minds of folks there? Or, I mean, what's happening?
Yeah, I mean,
I don't follow
they
that
have
market. I assume that's probably the case, but just
yeah.
curious.
Yeah, they have specific voucher programs and other kind of like rent control that they're pushing through the city. And I mean, we can go back and forth. I mean, there's benefits to doing that in certain asset classes, but a lot of times what it leads to, buildings being neglected, and property value going down for everybody. So so that's kind of what we were up against.
Yeah, no, understood.
But
Curious
I
as
still
to
have to say that given the right opportunity, I would jump at it in Denver, because I
Sure.
just think Denver has a lot of positive momentum as well as a
Yep.
city. So
Yep, absolutely. Talk to me about the next 3 years. What does it look like through the lenses of Daniel and the team there at HLC?
sure. Yeah, well, we're pretty excited. I mean, I think that there will be opportunity. I don't know that it's going to be kind of like everybody's waiting for this kind of, oh, it's going to be 2010 and where people are just going to buy and it's going to be so easy. Like, I hear a lot of discussions around that. I do, I obviously, if that's the case, then I won't complain, but we're not really prepared to do that. Basically, our overall thesis is that, we have no idea where interest rates will go, but we feel that they will either stay kind of where they are, which are, as a reminder, historically, they're not that elevated. And then eventually, will they go down, by 50, 50 basis points? It's just hard to know. We don't know. But we feel like with the amount of acquisitions that are probably coming through the pipeline in terms of sellers who need to sell, and also just people that need to sell, not only because they're forced due to the financing situation, but also, funds that come and they have to redeem their funds and so on and so forth. So there are sellers out there and the market is down. So it's kind of this interesting period of time, but we're looking at it from more of like a early 80s and early 90s standpoint, and less of like, just kind of where nothing seems so amazing. It doesn't look like there's going to be all kinds of free money. But if you can buy in these periods of time when there are discounts, and you can buy at a good basis and hold on for a longer period of time, we feel that it's a pretty opportune time.
Yeah, no, I agree with you. And just curious, when you guys are underwriting deals today, I mean, you're looking at over a 10-year hold period, and then if so, what does that, how much are you adjusting? Either if there's a recap, maybe in year 5 or exit year 10, whatever. How are you adjusting? What your expectations for cap rates might be at that exit or recap period, and then also what values might be, cap rates and
Sure.
interest rates on the loan.
Yeah, sure. Yeah, so I'll give you an example. I mean, we were close to purchasing a property, which in the end we didn't purchase due to some due diligence stuff that we uncovered. But in general, this property seemed like a great property for a long-term, for our long-term hold strategy. But it was a 1980s deal. But we liked a lot of the factors. We were getting it at a great basis. We really felt positive about it. And so, we had basically factored in for 10 years. We would hold it, and then the sale, the cap, I think probably there we did, we generally put in a couple basis points above at least a couple basis points above what the cap rate we're buying it at is, just because we don't know where cap rates will be. So in that deal, let's say that the cap rate was at a 5.5, we would put it at maybe a 5.75 or something of that sort. But then the fact of the matter is, we got to the property and we said, what, this is a great deal because of the basis that we're able to get it at, but we don't want to own the deal for so long because it was a little bit rough. So then we just readjusted what our business plan was, and we made it a 5-year deal, right? And then if it's a 5-year deal, but we still have there still needs to be some sort of buffer between the cap rate you're buying it at and the reversion cap rate, the cap rate you're selling it at, just assuming that cap rates, will go up. I mean, you can't bank on them going down, at least where we are right now. We don't think.
Yeah. As far as the vertically integrated property management side of the business, I guess maybe if you would, kind of pros and cons of you guys, it seems like from what I've read on the website, you guys have pretty much been vertically integrated for a very long time. I mean, you stepped into it. Was it already there? Was the property management already in place?
Okay. Yeah. So no. So well, there was always property management, but not as like a more institutionalized management company like what we have today. It was more, okay, we got an accountant, we got it, like we're bringing in the bills, we hire like the person when we need them, that type of thing for the retail. Because retail is there's some areas where it's more management intensive, but all in all, it's not nearly like multifamily. When we went into multifamily, we made a intentional decision to say we're going to set up institutional, property management protocols, SOPs, and everything in order to be able to manage these properties. Now, I'm happy to get into the advantages and the disadvantages, because I am convinced that the vertically integrated model is better, but it's hard to convince me of that because having to do it is much more challenging than it seems. You know what I mean? I mean, like the amount of risk
it's a necessary evil, right? It's a necessary evil.
Yeah. Right. It's a necessary evil. I also think that it comes from kind of like also the family business mindset of, you got to kind of like be in control of the chain of events that happen within your assets, so I would say advantages and disadvantages. I'll start with the disadvantages. Disadvantages is it's expensive. It's really expensive, right? Like, I mean, like we have so much lost cost, time, and everything on the platform just because it's a business in its own, and we're not doing it. We're not doing the property management for kind of like third party groups. We're doing it for our own assets. So it's not like we make any money on it. And then the other disadvantage is the inherent litigation risk. Like property management companies, get sued. You're dealing with all kinds of different, the capex issues and tenant matters and all kinds of different stuff. That makes it really challenging. The good side of it is that we feel like we are very much we're boots on the ground. We're there. We're able to know immediately. I mean, I check in with our property management team frequently, if not daily, and so we're getting daily updates. We know what's going on. We're getting even if we're not in the city where the assets are, we're getting pictures of what's going on at the property constantly. If we have an issue, it's not like we have to talk to somebody at a property management company. We're calling directly. If it's not to the property manager, it might be to the leasing or to the maintenance. So I think that creates a lot of operational efficiencies that are extremely important. So that's kind of, and by the way, we went beyond that and we launched a brand that's more of a consumer facing brand for our property management operations, which is called Layers, which really kind of brings about, it both integrates kind of like today's technologies into property management. And it also, it comes with the thesis that residents want to kind of feel a connection to the management company that is overseeing their properties. And so if it's like XYZ management, it's a little bit less personal than if it's Layers and we have a bunch of community events that we do on and so on and so forth. So I do think that it helps to add value to the property ultimately for the investment, but it is from an operational standpoint, it's a big lift.
Yeah, no, I agree with you. We're vertically integrated as well, and I can agree with all those points that you just made. Again, necessary evil. It's not a profitable side of the business, and just but it gives us a lot of control and direct point of accountability as well, and not have to have that additional middle person involved. And again, no one's ever going to have the same alignment of interest as you're going to have with your own property. So no matter how good of a property management company it is, it's just never going to be the same.
That's right.
You guys are based out of where? HLC, their headquarters is?
So our headquarters are in Pittsburgh.
Okay.
Physically we have we're pretty distributed in different locations. So
got it.
We have headquarters in Pittsburgh. We have around 30 employees in Dallas because of our multifamily operation there. Director of acquisitions in Atlanta. So we have people in a lot of different locations, and I actually split my time between Israel, where we also have a back office, and everywhere in the U.S., including Pittsburgh and Dallas and everywhere else, wherever the business requires me to be.
Got it. No, that makes sense. I was just curious as to what that looks like. I mean, is everyone is most of the team headquartered there in Pittsburgh, or are you guys spread amongst various cities? And it sounds like a little bit of both.
Yeah. It literally is a little bit of both, and we get together, but it helps us because we're in different locations. It helps us cover a lot of ground at the same time. So,
what have you found? One last question on the property management side. What have you found to be the size or scale of how many units do you have to have in order to justify maybe going into a new market? Obviously it might be a loss leader initially, but like, hey, we need the ability to acquire 1,500 units in this new market to have it make sense over the next 2 years. Is there a certain number that you guys shoot for in order to justify going into a new marketplace?
Yeah, I would definitely say that, in order to get into a new market, we definitely want to be able to own 200 to 300 units. But that's, like you said, it's a loss leader. And definitely, I think that once you get to 1,000 units per market, it's not like it's, that's a home run, but that makes it a lot more efficient for sure.
Yeah, fantastic. Well, any advice that you can give for those? I mean, again, family business. I'm sure that most people are probably like, well, that's great. Dan doesn't have to do that much work. He just kind of stepped into the family business. Obviously, that is not the case, right? So talk to me about just maybe some of the the learning adjustments, what you had to do in order to, get in. Your grandfather built this a long time ago. Obviously,
Right.
you've helped grow the company significantly over the years since you've been at the
Yeah.
helm. But
Yeah.
just even getting respect. I'm sure there's challenges around just that alone, right? Like
Sure.
Daniel stepping in, the grandson,
Yeah.
and people are like, oh gosh, here we
Yeah.
go.
Yeah. Yeah.
So
Yeah.
talk to me about
Yeah.
managing those challenges.
Yeah. Yeah. For sure. No, definitely. And it's funny because um, there's definitely that that kind of that overall feeling definitely exists for I in the industry in general. I think that really at the ultimately whatever you're given, right? If you're born in America, if you're born with two parents, like whatever you're given, your job is to take whatever is kind of like life gives you and to make the most out of, right? So that's really how I just view it from day to day.
Yeah.
And I think that the most important thing is to have really strong work ethic and to just continue building whatever you can. And that's really what we've been focused at the company. It's funny because I used to kind of like downplay the family business. And then the feedback from all of our team members when we were kind of like doing some strategic thinking was like, they were like, Daniel, we're a family business. There's like a legacy here, and that's what we want to work with. That's what we want to work for. Like let's lean into that. And so really we've kind of just like leaned into it. But there is, a factor of it. When I get kind of cynical, I call it like the entitled side of the business, which is kind of like legacy portfolio, versus our growth side of the business, which is really kind of like our sponsorship, more, aggressive side of the business. But it actually plays into, and I'm interested to get your thoughts on this. So cash flow is great, right? And that's why,
Yeah.
Lots of people invest for cash flow, and you have a book after that. But the thing is cash flow can be seen as kind of like an entitled element of the business. And this is what I mean by that. You have to, in order to have cash flow, you have to generate capital, right? And so our deals, we always are kind of focused on cash flow is great, and I could live cash flow all day. But if you want to grow capital, you also have to make like certain moves in the real estate business to grow capital so that you can generate more cash flow.
Yeah.
Right. So in our business, when I mentioned the entitled versus non-entitled, it's that mixture. So I'm curious how you view that as well, because you wrote
Yeah.
the book on it. So
And we take the same approach. I mean, we have a growth side of the business as well as an income side of the business, and we're very much, while we're not a family company per se, we very much look at our team, Sunrise, as a team, as a family, and we really do want to hold assets for a long time. So we look at kind of the long term vision as well, and we've really worked hard to find the right investors. A lot of folks have money that want to put money into different respective deals, but we really want our investors to to be on that long journey with us. We want to find the right ones that really, they're in a different stage. They're not having to hit home runs, every time. Like in fact, they're looking for more wealth preservation at this point in time.
Yep.
So more of like a set
Yep.
it and forget. And so while we have to have an emphasis on growth. We do growth deals. We really
Yep.
want the ability though to recap those deals at some point in time and truly have them as legacy assets in our funds. So we've got a number of funds that have assets that have been there for many, many years. Basis is really low, while there might be not as high of a return on equity because we got such a low loan to value, we're meeting our investors' objectives. I mean, of just mailbox money every quarter. I don't
Sure.
have to worry about anything. Just set it and forget it. And so really just
Yep.
living off that cash flow. And so,
Right.
we have a mixture of both within the orgs. And as you and I mean, it's very difficult. Um, it has been very difficult for many, many years to truly buy a deal right out of the gate that has cash flow. That a lot of times there's
Right.
just not the spread there. You got to create the spread, and a lot of opportunities. Even if you went to recap it, it probably still wouldn't cash flow even after adding value, over a number of years. And so a lot of times you're actually forced in order to realize that profit you've got to sell. You've got to sell at some point in time. So
Right. At some point.
um,
Yeah.
yeah, at
Correct.
some point. I mean,
Right.
I like to find deals where we don't have to sell, but inevitably we still do deals where we pretty much like that's the game plan. Like we've got to be able to get in and get out and make our
Sure.
investors a lot of money, and then hopefully that allows us to maybe cherry pick the ones that we want to hold for a very long term. So,
Yep.
uh,
That makes sense.
but yeah, and
Cool.
really at the end of the day, cash flow to me, how we look at it. I mean, just from a myself and my business, I've got one other partner, principal in the company. It's just more about cash flow, finding assets that allow us to, create freedom within our lives and our investors' lives as well. It's kind of like what we preach is buying investments that can literally just offer distributions on a quarterly basis. Again, can be legacy assets. And again, really wealth preservation. Just, I don't need to hit double digits all the time. Just help me have my money grow. And also on top of that, a lot of our investors, it's funny. Again, we've really spent a lot of time really honing in on who's a good fit for us and who we're a good fit for. It's always that call that you have with your investors. Hey, we're returning, some of your capital back to you. We're selling a couple of deals. I have found that those are more difficult conversations. A lot of our investors are like, well, now I got.
What am I going to do?
No, I got it. It was great. We got all this depreciation, but now it's going to be you're making me a lot of money, but I've got a tax issue, and I got to find something else to put it back into. So do you have something else, right? And so, anyway, it's an interesting.
No, we definitely found the same thing. Yeah, I agree with that.
Yeah. Cool. As far as, I guess, for those folks that want to learn more about you, Daniel, about the company, about any offerings that you guys have available, where's the best place to learn more?
Yeah, so I welcome anybody to, we're actually just in the process now of putting up a new website with our new branding. So anyone is welcome to go to hlcequity.com. We have multiple ways to contact us there. And then on social media, feel free to connect with me on LinkedIn, Daniel N. Farber on LinkedIn at HLC Equity. And, happy to connect with, whether that's potential investors, partners, people that just want to chat, whatever it may be.
And just real quick before we wrap this up here, do you guys typically do individual deals, or do you typically do a fund structure? Or
right now we don't have a fund structure. Right now we're doing, deal by deal. In the future, there's a good chance that there will be a fund structure. We're in the process of that, but right now it's deal by deal.
Okay. Yeah. Got it. Well, fantastic. Well, Daniel, thanks for coming on the show. It's great having you here and learning a little more about your company. So you take care.
Definitely.
Okay?
Yeah. Thank you.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care.